While traders are digesting fresh news about the market situation and the key assets have taken a break after a period of high volatility, it's a time to learn what the upcoming week may bring. It's likely to be as eventful as this week. Investors may get clear information about future changes in the monetary policies of some global central banks. And we will take a close look at the events that traders should take into account. You're watching Traders Calendar. The beginning of the next week is expected to be quite calm. On a Monday, there are no important macroeconomic events. Meanwhile, on a Tuesday, traders will focus on the business confidence indicator. Thus, during the Asian trade, the National Australian Bank will issue its business confidence data. In February, the indicator dropped to 0. The figures were below the long-term average readings. At the same time, the retail sector proved to be the main obstacle against the backdrop of a high borrowing cost and high inflation. Confidence remains weak, which corresponds to continued pressure on the economy. Meanwhile, price pressure remains strong despite the ongoing economic slowdown. Notably, the Reserve Bank of Australia raised interest rates to a 12-year peak of 4.35%. It also warns about another hike. In this light, the data could affect the Australian dollar. If the data reveals an uptick in business sentiment, the Australian dollar could get a short-term boost. Otherwise, bearish sentiment may strengthen. Later on Tuesday, the Cabinet of Japan will also publish consumer confidence data, although the Bank of Japan hiked the benchmark rate for the first time in 17 years. The commitment of its policymakers not to rush to further increases hit the yen, and the situation is also aggravated by a bigger yield gap with the United States. Japanese officials were trying to boost the currency for several days. A threat of intervention provided considerable resistance to the US dollar. Fresh statistics may help shift the focus to the sentiment within the country from speculation around the intervention. Japan's Consumer Confidence Index rose to 39.1 points in February 2024 from 38 points in the previous months. This was the highest reading since December 2021, as a household sentiment strengthened across all components, namely overall likelihood, income growth, employment, and willingness to buy durable goods. A better than expected reading could help the Japanese currency to regain some losses, while more negative data would only add to the pressure. On a Wednesday, all eyes will be turned to the Reserve Bank of New Zealand, which will make a key rate decision. In the previous months, the Reserve Bank of New Zealand kept the key rate unchanged, thus meeting forecasts. At the same time, officials lowered the projected peak in rates, thus surprising markets, as the policymakers said the risks to the inflation outlook had become more balanced. The Reserve Bank of New Zealand's rate forecast and comments were also slightly more dovish than some traders had anticipated. This led to a sell-off in the New Zealand dollar and a bond rally. By the way, recent data showed that New Zealand's economy unexpectedly contracted in the fourth quarter, pushing the country into a technical recession, and now markets foresee a 55% likelihood of a key rate cut in July. A quarter-point rate cut isn't expected in August. If on a Wednesday the regulator fails to meet expectations, the sell-off of the New Zealand dollar will continue. However, if the central bank puts hawkish rhetoric back on the agenda, the currency will get support. The publication of the US inflation figures will be the main event on a Wednesday. In February, US consumer prices showed a confident rise amid higher prices of gasoline and houses. And this points to inflation stability, which may prevent the Federal Reserve from making the anticipated key rate cut in June. In the previous months, the consumer price index climbed by 0.4% after a 0.3% rise in January. Petrol and housing, including rents, contributed more than 60% to the monthly CPI growth. In the 12 months through February, the consumer price index jumped by 3.2% after rising by 3.1% in January. Excluding prices of food and energy, the CPI added 0.4% in February. After manifesting the same increase in January, housing was also the main driver of the so-called core CPI. On a yearly basis, the core CPI surged by 3.8%. That was the smallest year-over-year gain since May 2021, following a 3.9% increase in January. If the next pool of data shows an intensification of price pressures, the US dollar could continue gaining value without hesitation. At the same time, signs of a cooling inflation could put strong pressure on the greenback. The announcement of the key rate decision by the Bank of Canada will close the news flow in the first part of next week. Investors suppose that the central bank will keep the benchmark rate unchanged at its 22-year high of 5%. However, it may start lowering the key rate in June or July. Moderate economic growth and cooling inflation are contributing to early cuts in borrowing rates. The Canadian Central Bank may also need deeper cuts in the current cycle, as the economy is much more sensitive to interest rates due to household debt. About 1/5 of Canadian mortgage holders are expected to renew for their contracts next year, and a rate cut could give them some relief. The market is not expecting any surprises from the rate decision. However, future reversal in monetary policy seems closer than ever. Traders will be mainly focused on the regulator's statement. Hints about the June easing could put pressure on the Canadian dollar, while a restraint of a hawkish tone would be supportive. It was a brief overview of the main macroeconomic events from InstaForex analysts. Keep an eye on the data released and open profitable trades. So see you online next time.